Lovely. Can you hear me okay?
Yes.
Great. Well, it's a huge pleasure to be able to chat to you. I'm gutted I'm not with you. I really wanted to be there, but unfortunately I'm in Tbilisi. I've never been there before, never been here before. Seems a slightly odd place. But I'm here at the annual meeting of the Asian Development Bank, presenting an idea on how we might get some of that $1 trillion of cross-border flow to developing countries ignited. I'm going to present to you in a totally different way than I intend to present it to them tomorrow. I hope I get my presentations the right way around. But let me begin by saying that I've enjoyed listening to the presentations so far. We clearly share many common perspectives, and I want to focus on perhaps some different perspectives so we can move our conversation along. A lot of us, clearly we're a long way away from where we need to be, a very long way away from where we need to be. But we also a little bit progressed from where we were just 2 or 3 years ago. And I think that's partly because over the past couple of years, we have managed to raise the issue of scale and scope in a way that we weren't really able to do before. So everyone's now heard of the $2.4 trillion or $3 trillion number that is needed for developing countries to finance their response to climate change, mitigation, adaptation, loss and damage. And of course, for the SDGs, we need even more than that, probably a figure closer to $5 trillion. But we've converged around some of these numbers. These are big numbers. They've got huge margins of error. And you can imagine that we as economists love to disagree with each other and to have our own number. And one of the key campaign decisions was to try and converge around some common numbers. And I think that's worked very well. You now hear 2.4 trillion or 2 to 3 trillion being mentioned in the G20, in the COP, Bridgetown Initiative, in many places. And the reason why scale is so important is that it has helped to illustrate why a number of the things that developed countries in particular were trying to push as solutions could be very clearly seen as not solutions. When you need $2 to $3 trillion, you can't get it all through domestic mobilization. Especially if investment is going to far exceed anything that's been done before, that means it's going to far exceed savings. Investment exceeds savings, you need a big amount of capital flows. Probably $1 trillion, and I totally agree with Kevin and the team. That's probably an underestimate. It's probably a bigger number. Looking at scale also tells you that concessional debt is not going to do it. There isn't enough room on developing country balance sheets for all of that debt. It tells you that we need to really rethink the DSA, but I would argue in a slightly different way than we've just heard. It tells you that the voluntary carbon credit market, it's a nothing. It's $2 billion a year. We need 3 trillion, and you're focusing. I mean, most of the time people spend when we go to these conferences, not yours, but when we go to other places, they want to talk about carbon markets and voluntary carbon markets, and there's a tremendous amount of excitement around some kind of $2 million project here, $10 million project there. $2 billion per year after all of that hype, and half of it's in India. So ex-India, $1 billion is the voluntary carbon market. I actually find it weird that so many economists get involved in voluntary carbon market. It's as if Arthur Pigou over 100 years ago said, don't worry about externalities, they'll be solved voluntarily by the private sector, reaching some kind of voluntary agreement. I find it odd. The other thing is scope. So we've talked a lot today about LDCs. And I think it's important that we remember, we're talking about a global problem. 70% of the world's poor do not live in the poorest countries. 70% do not live in either countries. We can't think of this world and we can't think of poverty and not be thinking about what's happening in Brazil and India and Indonesia and Pakistan and Egypt and Ethiopia and Philippines and Vietnam. And that's about 2.5 billion of the world's poor living in those countries. So we need to think about this in a broader way. And I think that's important because the debt issues, the development issues for those countries are not the same as the LDCs. They tend to have a big amount of they have a private creditor problem rather than an official creditor problem. Both of these problems are important, but we can't ignore the private creditor problem. We can't ignore solutions to that. So the response to what is needed, 2 to 3 trillion, is still around a number of fantasies. There's the fantasy that the private sector can do it all. And the private sector is doing a certain amount of things in certain areas in developed countries. And I don't think we should ignore the possibility of where the private sector could be helpful. But I find it impossible to go to a conference on mobilizing money without someone saying how the private sector can fund adaptation. There's no evidence the private sector is funding adaptation, and there's no real reason why they should. They have very few revenue streams. It's as if all of our students of the Arrow-Debreu model of economics thought that we were actually describing a real-world example. That there really is, infinite contracts, very infinite possibilities in the future. And if you can make savings in 30 years' time, you can bring it home and make some money today. That doesn't happen in rich countries. It's not going to happen in poor countries. Insurance is something we often get fobbed off with as well, especially with climate disasters, insurance. Climate is an uninsurable event. Insurable events are things you can spread across time, things you can spread across different asset classes, things you can share in different pools. But when you've got a known and certain risk that's rising, and rising in frequency, rising in correlation, rising in size, insurance does not give you any magic at all. If annual costs are $150 billion a year and rising, our insurance premium is going to be less than $150 billion per year. And who's budgeting for those? There's no magic there. So as you know, some of you have heard our system that we've described before. The way to get to 2.4 trillion is to say, look, we'd love to have all of that in grants. It ain't going to happen. The total amount of ODA money is 1/12 of what developing countries need every year. 1/12, $200 billion versus 2.4 trillion. And that number, it ain't going up. It's being reclassified, rechanneled. A big chunk of it is actually on domestic things, domestic expenditure in rich countries. So what can we expect from that number? Not a massive increase. People should campaign for it. People should argue for it. Morally, it should be totally different. But if I have a perspective of a developing country government, I'm not going to wait for that to happen because it's not going to happen anytime soon. And people are dying today. People are being impacted today. Livelihoods are being destroyed today. We can't wait for that to happen. Let people campaign for it, yes. But we need a solution that works today. And so we say put all of those grants into the thing that can't be funded any other way. And that's loss and damage. If you had all the grants in the world and the extra grants, and we need new taxes to expand that, and you had these new taxes, you had $1 on a barrel of oil, you had CBAM money redirected, you had shipping and aviation taxes, you might get enough money for loss and damage, the smallest need. You won't get much left over for adaptation and resilience. The good news is that adaptation and resilience does generate savings. So if we had long enough debt, long enough to capture those savings, low enough in interest rates, developing countries could probably borrow for resilience. And they'll need about $300 billion for that per year. And their scope for adding that onto their balance sheets is limited. My experience with the DSA is not that they don't take into account climate shocks, actually. They do that manually. And when they do that, their interpretation, the IMF, their interpretation is that means that you no longer need to hit 60% debt to GDP ratio in 15 years. Because you are subject to climate shocks, they tell us, you need to hit 50% to debt to GDP, and that means your primary surplus target needs to be even higher, or your restructuring even higher. But invariably, being it's mostly fiscal, the conclusion they draw from manually bringing in climate shocks into the debt sustainability analysis is that primary surpluses need to be higher. We need some rethinking. And the rethinking, I think, is about what kind of investments create future savings. So you can't have a debt sustainability analysis that actually stops you doing prudential things, investing in saving you money in the future. That's what we have today, and I think we should focus on that reform first. We need to count different types of debt differently. Debt that saves you money in the future, assessed by some independent people, not the people who are benefiting from it. That should have a different weighting in the debt sustainability analysis, creating fiscal room for investments in resilience. Let me end my remarks on how we can use the private sector and what needs to change. So we need $1 trillion of flow in mitigation, at least. Mitigation is being funded, 81% of mitigation is being funded by the private sector in developed countries. They're not going to developing countries. And, because multilateral development banks are project financiers, because the theory of change, the theory of development in rich countries and developed countries, the theory of development in rich countries is that the problem about development is these poor countries. The problem is developing countries, is their theory of change. They need, if only they had the right policies, the right regulation, they wouldn't need our money, they will develop on their own. That's their theory of change. It's weird, the multilateral development banks are the only banks I know who complain continuously about their customers. And I think that the reality is we have a system. We have an international financial system that makes it hard for development to take place. And let me describe it in this way. So domestically, in the domestic banking system, we have created a system where you have things called safe assets and risky assets. The government determines what is a safe asset. Economists like to think that safe assets are safe assets. No, the government says that the government bond is a safe asset. It may not be a safe asset, but it's a safe asset. It counts as collateral. It counts as safe assets for the banking system and the insurance system. And that gives it preferential status, but it counts as a safe asset. And you can lend based on how much safe assets you've got. So this is the way the domestic system works. In the international system, we've also defined, but less formally, through accounting rules, through the way credit rating agencies operate, the way multilateral development banks operate, with a world of safe assets and risky assets. And rich countries have safe assets, and they export safe assets. The US dollar, the euro are safe assets. When the world is in crisis, people flee to those places. They're viewed in a number of formal and informal ways as safe assets. Developing countries have a fundamental problem. They have to import all of their safe assets. They don't have safe assets. And that means if you're investing in Brazil or South Africa or India, even India, then you have something that you don't have in developed countries you have to deal with, which is the international financial volatility. When the world is risk averse and the money is fleeing from those countries into safe assets. Now, if you're an investor, you have to factor in the cost of that. In the long run, the currency may fall by 10, 20 percentage points, but the short run cycles around that are large because those countries are risky assets. They may have the same, India has the same debt to GDP ratio as Europe, but the rupee is no international safe asset. And the volatility around the risky markets is high. And so when the private sector hedges its risk, its hedges have to take that into account. And that's why they charge twice as much to hedge the risk of investing in emerging markets as the actual decline of those currencies. They're charging twice as much as the actual risk. And that's not because there isn't a risk. It would be wrong to say this is all a prejudicial bias. It's because they know that when things are tight, your developing country currency is going to be collapsing. Your interest rates will be rising. You are going to have difficulty. Whilst in a crisis, what's happening in the safe asset country, in the developed countries, is money's flowing into those countries. Their interest rates are falling. They can act counter-cyclically, whilst developing countries are forced to be pro-cyclical. And the pricing of that risk creates this huge cost of capital. And that's why the cost of capital for investing in mitigation projects in developing countries is considerably greater. In fact, if you subtract the macro cost of capital from the cost of capital of investing in renewable energies, you find that the micro cost is no bigger in developing countries as in developed countries. And I know many project financiers, multilateral development bankers, they find that hard to believe because it goes against their intrinsic belief that the problem is the countries. They've got the wrong policies, the wrong regulation, they don't have an investment plan. I mean, who knows what the UK investment plan is? And yet we're told continuously by people that those countries, they don't have their plans. Who knows what the UK's mitigation plan is? It changes, keeps on changing as well, even if you did know it. But the theory is the countries have a problem because they don't have plans. They don't have regulation, they don't have policies. But if you look at the cost of capital numbers, the actual cost of capital numbers, subtract the country cost of capital, so what you're left with is the project cost of capital, you find that that cost of capital for the project, the micro risk, is no bigger than in a rich country. Why is that? Well, that's because we in developing countries, we have to offer investors absolutely everything. So in fact, the project risk is no higher in a developing country than in a developed country. We have to offer the foreign investor that they are guaranteed their tax rates for the next 30 years. Whichever government gets elected for the next 6 elections, next 6 times 5 years, you are impervious to any domestic change in policy. And if we change policy on you, you can take us to court, an international court, not a domestic court, a New York court, a London court, and sue us and get compensation. And so, in fact, micro risks are smaller in developing countries or the same. The macro risk is the problem. So the way we are proposing to address that is we're saying, well, in a crisis, people are fleeing developing countries and going to AAA rated institutions and countries. Multilateral development banks are AAA. Maybe that's the one good reason for them holding on to that AAA status. They can act counter-cyclically. So what we created at the Inter-American Development Bank for Brazil, and we're hoping to make that global, and that's what I'm hearing Tbilisi presenting, is a platform for eco-investments, climate and biodiversity investments. And on that platform, well-regulated projects, we offer to be the counter-cyclical lender of US dollars where they've got foreign investors and they've had to attract foreign capital, or that they have foreign supplies. So when the crisis hits, we are prepared to smooth out that steep decline and offer 5-year, 10-year money, US dollars at our cost of borrowing, which is, of course, much lower than the country would have at a time of crisis. So acting as a counter-cyclical lender, something multilateral development banks can do with their AAA rated status, allows us to smooth out that cycle. And if we can smooth out that cycle, we're acting as a countervailing force for this international financial system, which penalizes developing countries with these huge feast and famines and cycles of risk. So that is the way we think that we can get private sector money into mitigation projects in developing countries. We need the multilateral development banks to be 3 times bigger, doing the concessional lending on resilience. And of course, we need to have new taxes for grants and grants for loss and damage. And that's the way we might get to 2.4 trillion. Thank you very much.